Hello, everyone. I hope you all are doing well. Let's get started with Chapter 11, Study Unit 11, Cost and Variance Measures of the CMA Part 1. Very important topic. Very simple topic also. But most of the students get confused that what formula to apply, when to apply a formula, and actually how do we get to know that whether it's a favorable variance or whether it's an unfavorable variance, because sometimes when you get an answer in minus, you may say it's favorable or it's unfavorable, vice versa. So now what you guys need to understand is we must not go with the formula in this variance measures. We must go with the understanding of the variances. For that, let's get started with these variance analysis. Now, why we are using variance analysis is because just to understand that whatever you budgeted, whatever you estimated, how is it equivalent to the actuals? How much is it equivalent to the actuals is the question. How is it relevant? This is the biggest question which is coming in. Okay, whatever you predicted, whatever you estimated, is it accordingly right or not? Or if not, then what are the changes to be made in your standards so that you can reassess your assessment procedures and then have a proper standard set so that you don't have much variances coming in. Why see, sometimes they say that okay, I budgeted an expenditure of 10,000 rupees, but now the expenditure is 7,000 only. So it's a good variance, means that's favorable, that's good. But sometimes why is your calculation going till 10,000? Why not somewhere around the 7,000 only? Here comes, like, here comes a budgetary slack. Now when a slack is coming, why is a slack coming? That is the question here coming in this budgeting. I hope you guys are getting it. So now variance analysis, what happens is whatever is your expenditure, whatever your expenditure which you had estimated, expenditure estimate, whatever you had done, within, with that, is your actual expenditure more than it or less than it? That's the question. If it is more than that, then it is an unfavorable variance. If it is less than that, then it's a favorable variance. I hope you guys are getting it. On the revenue side, see, when if it is a revenue which is going to come, and if suppose your actual revenues are exceeding your budgeted, then it is a favorable variance. And if it is going the other way around, then it is unfavorable variance. I hope you guys are getting this. Now, moving forward, assignment of responsibility, overview of variances. Now what happens is, the crucial part of variance analysis is the assignment of responsibility. The performance measures on which managers are judged should be directly related to the factors that drive the element being measured, that is cost drivers. The goal is to assign responsibility to variances to those most likely to have information that will enable management to find solution. The constructive approach is to promote learning and continuous improvement in manufacturing operation, not to assign blame. However, variance analysis may be useful in evaluating managers' performance. Why managers' performance here is because manager is the person who is setting those standards. Now, when those standards are changing or when those standards are getting variances, the reason is the manager has not set proper standards. So you are assessing the performance of the manager. All right. Now this is an overview of variances, static and actual budget. Hope this you guys understand. Why we are doing this is, suppose there is an actual thing coming in, actual cost, actual things which are happening, actual expenditure, actual revenue which is happening. That is compared with what? That is compared with the standards which you had set. Now, the standards which you had set, how right is it? Is the number of units also sold, is it that same? Then the variance can be made. Now, whatever variance you make, like, actual results minus static budget, you would get a static budget variance. But it does not sum this at all. Matlab, this will not give you a proper variance analysis at all. For that, what you have to do, you have to make a flexed budget. Now, what do you do in a flexed budget? What is the work done in a flexed budget? Suppose you have, you know, a static budget is telling that you have to sell 10,000 units. Now, when you have to sell 10,000 units, is the actual also selling 10,000 units? Then you don't need a flexible budget here. But if suppose the actual which you are selling is somewhere around 9,000 or somewhere above like 11,000, what happens here is that in this, the complete expenditure which is coming, that is relevant to this. So if it is 9,000 compared with 10,000, 9,000 compared with 10,000, then you know the answer straight away. When 11,000 is compared with 10,000, then also you know the answer straight away, that whether it is a favorable or unfavorable variance. So that does not give you the right picture, that does not give you the right variance. So what we do is nothing but we prepare a flexible budget. A flexible budget, how? Suppose your standard set was 10,000, but your sale happened 9,000. So what we do, we take 9,000 as the inputs, and then what we do, we multiply this with all the standard rates. We multiply it with all the standard rates. Now when we multiply this with all standard rates, what we will get a flexible budget. Now this flexible budget, I can compare it easily with the actual results. Now when I am comparing it with actual results, I am getting a proper picture, and whatever is there in the flexible budget, that is all with the standard prices only. Only the standard inputs, those are changing because that is actual. That's how you prepare a flexible budget variance. Now the other way around, you have a sales volume variance. That's also coming in down, in the subunit 8 it would be there. Then you got your static budget variance. Static budget variance is the sum of flexible budget variance and the sales volume variance. I hope you guys have got clarity out here. If you're having any questions, you guys can ask me, reach out to me anytime for it. All right. Now, let us proceed. Now, components of flexible budget. What will be coming under here is direct materials flexible budget, direct labor flexible budget, and factory overhead flexible budget. One by one, we would be seeing it out coming there. Then there is sales volume variance, which is sales yield variance, sales mix variance. That also we'll be seeing it later in the chapter. Now, advantages and disadvantages of variances. Make sure that you guys know this and apply this to identifies areas where actual results are being different from budget, and management can take action that where it is going wrong. Accordingly, they can take. Evaluates performance of personnel. Identifies budget estimates requiring inclusion in the revision. I hope you guys are getting this. All right. Now, disadvantages is the length of time it takes to identify a problem may be too long for management for effectively to take a decision. Hope you guys are understanding this. Then static and flexible budget variances. Here are just a theoretical concept. Static budget is prepared before the budget being period begins and is not changed. It is based only on whatever is the standard rate and standard output, standard prices as such. Standard prices, it is established by yourself, as we've seen it in budgeting. How do we establish standard prices, which is on par? Then standard quantity is nothing but maybe practical standards taken into consideration, or maybe ideal standards taken into consideration, which we had done it in the budgeting chapter. I hope you guys get it. Now, make sure that you guys may come across different names, different terminology in this outline. It is important to understand and apply variances regardless of the terminology used. Like standard price is also standard cost, budgeted price, and budgeted cost. And standard quantity is standard materials, budgeted quantity, budgeted materials. Now, once all standard prices are standard quantities are determined, the static budget can be calculated. Now, when it is all there, then only static budget can be calculated. And then later on what comes is your flexible budget and sales volume variances. That's how you would be creating it. Now this is what is a static budget. Static budget is nothing but, or static variance, you can see here, actual quantity, actual price, standard quantity, standard price. This is one simple thing, one basic overview. For sure, you know, if this question, if this type of MCQ is there in your main exam, then you are very lucky for this, because this type is, it's like a direct question, nothing, no up and down here, no, you know, no twisting of the question at all here. Now interpretation of static budget, okay, come on fast, you guys have already explained that to you. Now flexible budget and sales volume variance. What happens in a flexible budget? As I have said, you actual quantity will be taken and standard price is nothing but all the budgeted price would be taken in, and then what will be done is actual results minus flexible budget would be done. Whereas in sales volume variance, what we'll be doing? Flexible budget minus static budget we would be doing. Static budget is nothing but the main budget which you had made. Now this complete what we are going to do, see this one, flexible budget, and these all we would be doing, you know, subunit by subunit right now. And then last one would be sales volume variance, that is 11.8. You can go, as you can see this, what we have done here, actual quantity into actual price and all. What we have done, we have made one actuals here, and then we have made one standard over here which is static, and then this is the flexible budget. Now flexible budget in comparison with actual, what are the results you can see here, and then the standard budget and also actual quantity into standard price, which is nothing but flexible budget, you would get a sales volume variance. That's the comparison given. The question here is not finding out all this was there in, this is there in the previous chapters in costing. The question here is what is the variance, whether it's favorable or unfavorable. Now make sure, don't go here with, you know, plus or minus. Plus or minus symbol must not be there. Like if it is plus, then it is favorable, it is minus, it's unfavorable. Don't go at all with it. You would have lots and lots of problems later on. Just go with directly just go on with what is flexible, sorry, what is favorable and what is unfavorable. Now go with this. Favorable is what which is good for the company, and unfavorable is that which is not good for the company. I hope you guys are getting it. All right, now direct material variances. Let's get started with direct material variances. Now direct material variances, now you need to understand here is direct material flexible budget variance. Here in direct materials variances, what you will have is you will have a price variance, which is direct material price variance, and you will have direct material usage variance. Usage variance is nothing but your quantity variance. Now here is just a simple formula which you need to apply here to get the complete details, to get this complete problem solved. Now what do you do here is nothing but actual units produced multiplied by actual materials per unit multiplied by, now here he has done, here must be, here must be minus and here must be multiplication. Sorry, no, they did it right. Sorry, here must be, 1 second, something is wrong with this. Actual units produced into actual materials per unit minus actual units, sorry, standard must be there. 1 minute. All right, no, this is right. The direct material price, sorry, price variance equals the actual quantity of total input times the difference between the standard price and actual price. So here is nothing but the difference which is coming in the price. The price variance may be isolated at the time of purchase or when materials are transferred to the process coming back. Now there would be an unfavorable variance. There would be an unfavorable variance means that the actual price paid for materials is higher than the estimated standard price, and there would be a favorable variance when the direct material price, which is, when you're purchasing it, it is lower than what is the actual market rate or whatever you had already decided to pay. All right. Now, direct materials quantity variance. Now, direct materials quantity variance is more simple to understand here. That standard price multiplied by the difference of it. Difference of what? Here you can see standard price is multiplying it with the difference of actual units produced multiplied by actual materials per unit minus actual units produced into standard materials per unit. I hope you guys are getting it. Now here, an unfavorable materials quantity variance can come when the number of units used is more than what you had estimated, and it will be favorable when the number of units used is efficient or reducing. Then it would be a favorable materials quantity variance. It is going this way only whether it is good for the organization or not. If it is good for the organization, favorable. If it is not good for the organization, it is not favorable, which is unfavorable. All right. Now, direct materials flexible budget variance, you can see here. Showdown inclusive estimated output for the period of 18,000 units. However, actual output was 16,500 units. Standard direct materials per unit were established at 7.5, but the actual usage was 6.5. The standard price was budgeted at 6.75, but the actual price was 7. The direct material variances are calculated as follows. You can see here 18,000, you have just multiplying it with what? You are multiplying it with the materials per unit. Materials, how many materials are required per unit, and then the total output, quantity of total input, sorry, number of materials it is, multiplied by the price of per material. Now you get the total static, you get the total flexible, and also you get the actual direct materials. Now what we can do is nothing but we can have a difference here itself, so that we get the answer right away. And also here itself we can also have, variant usage variance and the price variance. We can even have a difference if here itself, as they have done it here, 7 minus 6.75 multiplying with 107,250, which is nothing but the standard, which was, sorry, which is nothing but the actual, which was there according to the formula. As you can see here, there's a direct formula given, which is nothing but actual quantity multiplied by actual price minus standard price. This is for what? This is for material price variance. Whereas for quantity variance, you can see here, what is this given here is the standard price multiplied by the uh, quantity, which is actual quantity minus standard quantity. I hope you guys are getting it and understanding it. Now the same formula is going to go forward and get, little bit of, added on to the labor side and get the labor variances. As you can see here, like here it says material price variance, here is direct material price variance, and here is labor rate variance and labor efficiency variance. The same goes on. Labor rate variance is there. Labor rate variance is nothing but the actual rate minus the standard rate multiplied by the actual hours worked. Get this right. Labor rate variance is nothing but standard rate minus actual rate multiplied by actual hours worked. Now with labor efficiency variance is nothing but actual hours worked minus standard hours to be worked multiplied with standard rate. You would get what? Your direct labor efficiency variance. You can see that here in this flexible budget variance here itself, they have applied the same formula, the same which you need to apply. Now in these questions, we will be doing it in our multiple choice questions session when we will be doing solving our online access. I'll be doing this once again over there, but here it's just an overview. Then mix and yield variance is very easy, very easy. But what happens is it takes time to do in the main exam. Now when it takes time to do in the main exam, people find it very difficult. Now it is actually not that difficult. If you practice it more, then you can perform it well in the main examination. Here you're having two: material mix variance and material yield variance. The same goes with labor mix variance and labor yield variance. What we do here is the same for both. See, to calculate these variance. Now, why are we doing this material mix variance and material yield variance? Suppose the number of raw materials, there are 2 to 3 different types of raw materials. There are 2 to 3 different classes of labor. For different classes of labor, there are different rates which are given. How do you find the variances for it is the question. Now, how do you do that? To calculate these variance, the entity must determine the weighted average standard price using the standard mix of inputs at standard prices and actual mix of inputs at standard prices. Now, how do we do that? You can see here, like budgeted hours are given here. These are different types of. Then there is standard wage rate which is given. Now, when we have this, what we do is nothing but we total this, 20,400 divided by 1600 hours. What have we got? Standard mix of standard prices, 12.75 per hour. And then we have got what here you can see, actual mix of standard prices. What we are doing here, you can see here, these are budgeted hours, these are actual hours. Now we have got this difference. Now once this difference is there, what you do is nothing but you minus this standard mix of standard prices and actual mix of standard prices. You have the difference and then you multiply it with actual total quantity. You would get your mix variance, whether it is labor or material, that will be the same. Now the same goes with yield variance. What we do, standard total quality minus actual total quantity, and then you multiply it with standard mix of standard prices, which you had already calculated here by using weighted average. As simple as that. Now the same can be applied for materials and labor. I hope you guys are getting it and getting clarity here. Now this you will get more clarity once you solve a few problems in the online access, GLIME online access. All right. Now the total overhead variances consist of 4 variances. Two are calculated for variable overhead and 2 for fixed overhead. Now how it is? Total variable overhead variance is the flexible budget variance. It is the difference between actual variable overhead and the amount applied based on the budgeted application rate and the standard input allowed for actual quantity. Now how do you do that? Is nothing but actual variable overhead minus budgeted rate into standard cost driver per unit into actual units. What are you getting here? Variable overhead variance. In this is broken down into again two: spending variance and efficiency variance. Now what is spending variance? You can see actual allocation base multiplied by actual application rate and budgeted application rate. This is what you have to do. Now when you do that, you would get your spending variances. Now you can see how is it broken down: actual allocation base into actual application rate minus actual allocation base into budgeted application rate. If you understand this, which is nothing but uh, the actuals minus the actual allocation base by the budgeted rate. So what you are doing is nothing but you are doing this difference of these two and multiplying. Now in this formula you can see in between it is written multiplied, but it is minus here. All right. Then there is efficiency rate. Efficiency variance, you can see budgeted application rate multiplied by actual allocation base minus standard cost driver per unit into actual units. I hope you guys are getting clarity over here. You can understand what is efficiency variance and spending variance. If spending variance is here, actual over variable overhead with the difference of this, and efficiency variance is with this difference of here. I hope you guys are getting clarity also here, which is variable overhead variances. The same has been applied in this problem. This problem I'll be doing it again in the online access. I'll be solving it. Now, fixed overhead variance. Here it's more easy. You have spending variance and production volume variance. See the minus plus here, it is there. Actual fixed overhead minus budgeted fixed overhead. Actual fixed overhead minus budgeted fixed overhead. You will get your budget spending variance. Fixed overhead spending variance directly. It's direct formula. It is multiplication, kuch nahi hai idhar. The same goes, you can see here with the production volume, you have to apply this formula, and this is the understanding for it. Actual fixed overhead minus budgeted fixed overhead is your spending and flexible budget variance for the fixed one. And then budgeted fixed overhead minus standard input allowed for actual multiplied by standard budgeted application rate, that would be your production volume variance. These are four-way analysis. Is there analysis of overhead variance? You can see here. Variable overhead spending variance, efficiency variance, production volume variance. Then three-way, you can see spending variance, efficiency variance, and production volume variance. And then two-way, you can see flexible budget variance and production volume variance. This has been applied with the same formula, just an analysis for it. Then there is a comprehensive example for all units. It is given for all direct material variance. It is given labor rate variance. It is given then material mix variance. It is given yield variance. It is given complete comprehensive example is there. I would be doing this again in when I'll be solving the MCQs for you. Now the last thing in this chapter, which is sales variances. Here in the sales variances, understand this, there is sales price variance and sales volume variance. Now this concentrates on contribution margins more. It concentrates on contribution margins more. For a single product, sales price variance is the change of the contribution margin. So what you do is nothing but actual price minus standard price multiplied by actual quantity, sales price variance. Same goes here. What happens is actual quantity minus standard quantity multiplied by standard contribution margin. Here comes standard contribution margin, not with the price, with this volume variance. All right, I hope you guys are getting this. Now, multi-product sales price variance, multi-product sales volume variance. For this, what we'll do, we will have what we'll do, we will be taking the weighted average here also and doing it the same how we did it with sales materials mix and material yield variance, which we did. We actually did it, we have to do it with sales mix variance and sales yield variance. The same we have to do, sorry, sales mix and sales yield variance, we have to do it. All right, I hope you guys are getting clarity out here. Once again, let me just complete this with sales mix variance. You can see here standard contribution margin is the standard units contribution margin multiplied by actual quantity minus total actual quantity into standard mix percentage, which is given right there. All right, I hope you guys are getting clarity up here with this sales. Just understand this, you have to do it the same way how we did it in the previous variances given above. Don't forget to come down to the next online live online access, which I'll be doing it on these questions of online access for the same chapter. Make sure that you do that too and practice those problems accordingly how I am showing that to you. All right, I'll be finishing this session and seeing you in the next session. All right.